Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly economic review for the week ending March 21st, 2025. So the question we asked this week is, does the Bank of Canada already regret cutting rates last week? There was first an inflation report this week showing that inflationary pressures are heating up in Canada. I mean, it's not dramatic yet, but we're seeing that the impulse is clearly to the upside and it's very hard to pinpoint one component. It seems to be broad-based. Likely the Canadian dollar, the depreciation of the CAD is putting pressure on import prices, so it costs more to import when the Canadian dollar is weak, so there's likely some of that as well. But there was a speech by Governor McLem in Calgary on Thursday, and he says that their job now is to make sure that they react accordingly to the new data, they react quickly rather than focusing on the long-term perspective as they usually do, and they want to avoid, and this is quoting Mr. McLem, they want to avoid the trade problem to become an inflation problem. And how does this become an inflation problem is if inflation expectations start picking up and the Bank of Canada is not able to re-anchor those inflation expectations. Because if businesses are expecting inflation to accelerate, that means that their costs will, they expect their costs to accelerate, so they will be front-loading price hikes, and this creates inflation. It's a kind of a self-fulfilling prophecy here that they want to avoid. So a very interesting shift in tone here that does raise the probability that the bank will have to reverse the recent cuts and maybe hike in the short run. But in the longer run, let's say by the end of this year, I think it's pretty clear that the Canadian economy will need lower rates, not higher rates. So it's a complicated situation, but in the short run, there are risks that rates stay as they are or even go back up a little bit. But in the long run, we believe that the economic impacts should dominate and we still see lower rates down the road. Now, maybe before we go into the details of what happened this week, looking at the data, the market returns. So very positive returns across the board during the week. Interestingly, if you look at Europe, the EFI index, so Europe and Asia, is up Canadian dollars 10.4% since the beginning of the year. There's more optimism, or let's say less pessimism about Europe, but now there are some sources of optimism with Germany just passing through Parliament a big spending package of 1 trillion, so 1,000 million euros of infrastructure and defense spending that should act as a kick to the German economy after years of fiscal austerity. This is, of course, helping the long-term prospects of Europe as a whole, and the market has been cheering it both on the stock side as well as on the currency side. You see that euro is up close to 5% since the beginning of the year, and gold continues to perform well given all of the uncertainty that we're seeing. Now, looking at the topics of the week, first an update on tariffs. And there was a very important interview by Treasury Secretary Scott Bessent on Fox News on Tuesday, and he gave some more color about what's to expect on April 2nd. And here, from the Globe and Mail, Trump administration is planning to announce a single country specific tariff rate. It's not going to be product by product, so it will be one rate per country on April 2nd, and then give the countries an opportunity to avoid the levies by lowering their own tariffs or addressing other American grievances. So they want to give a shot at other countries to negotiate. So it looks like, because things can always change, but it looks like on April 2nd we'll have announcements of rates, and then after that, there's going to be a window before these rates are applied. Remember that also on April 2nd is the current deadline for the extension of the grace period for the tariffs on Canada and on Mexico. So let's see what happens on that date. But that means, of course, we'll have very busy week on this one, but so far what it is shaping up is that we won't get those reciprocal tariffs at first. It's going to be more an announcement and time to renegotiate. So that's the update for the week. Again, it could change until then. Other than that, we had the Fed this week holding interest rates steady. They still expect 2 cuts this coming year. Of course, this is from the dot plot, so the survey of all of the participants around the table. And Mr. Powell, the Fed chair, did say that there was some inertia in those forecasts because it's so unclear right now that likely people just left their forecast as is. So those could change as we move forward in the year. So I wouldn't put too much credence to the 2 cuts by the end of the year story. But where there was some change in the summary of economic projections was on the growth side. So the participants are seeing growth in the US to slow down. The latest forecast that they had was 2.1% for the year. Now it's 1.7%, so minus 0.4. And they are also revising higher slightly, but still their forecast for inflation. So the Fed is of the view that the trade situation is negative for US growth and inflationary as well. So that's an interesting shift here, but we have to say that Mr. Powell did land the message very well on Wednesday. The Fed needed to project a sense of calm, and he was able to do this, and that explains why the market reacted so positively in the hours that followed this decision on Wednesday. Maybe finally now for the Canadian inflation numbers, it seems to be heating up, as I said earlier. On the left, you have total and you have core inflation. Again, we're not at alarming levels yet, but the trend has been higher. Of course, there's the impact of the GST holidays, it's for sure. But beyond that, we are seeing widespread pressures. Again, as I mentioned, likely the fall of the Canadian dollar is behind some of that, but maybe also we're seeing the Canadian economy heating up and it's already creating some inflationary pressure. So there's a worry there as well. On the right, the inflation expectations. This is the survey of economic forecasters. This is not market data, but still in the US, as you can see, the blue line expectations are that inflation will stay pretty much where it is right now throughout the year. So no more disinflation in the US. In Canada and in Europe, on the bottom, the red and gray line, you said there's been a bit of an uptick higher in the forecasts, but still well anchored. So this is where the bank will spend most of its time, most of its focus over the next few months. Our inflation expectations, are they staying put or are they getting de-anchored? So we'll keep you posted on how things evolve there for sure. So what's coming up next week in Canada? We'll have January 2025 GDP numbers, and in the US, the global PMIs, manufacturing should be down, services sideways, so there's not a gain of momentum in manufacturing yet. Conference Board Consumer Confidence Index, this is an important one. There should be a notable correction. This is what's expected. The University of Michigan survey has corrected quite a bit already. It is more tilted towards questions on personal finances. The Conference Board Index, this one here, tends to be broader, but more focused on the labor market. And this one has been holding up over the last few months, but now seems that the expectations are that it could kind of start to break. So that's going to be very important, because when you want to understand how the odds of a recession in the US and how it could unfold, the first component will be consumer confidence, which should lead to eventually, if it breaks, less consumption, and of course you have all of those trickle down effects. PCE inflation, the favored measure by the Fed, sideways for month over month, a slight reacceleration year over year. Nothing here to push the Fed to change its current views. So that wraps it up for the week. Always a pleasure to serve you. If you appreciate the content, please share, and of course, come back again next week.